Welcome back to another episode of the Grbcic Duo podcast. I'm finally joined by Tony, my dad, again. So, Dad, welcome back.
Thank you for the invite, Ed.
Well, it's our podcast. I think today what Dad and I are going to do is go through what the first quarter has been in commercial real estate for us, maybe go through a couple of the key transactions, get an understanding of what sort of yields and return those transactions did represent, and then talk about what might be coming in the next 3 to 6 months. So, Dad, let's, and I'm going to call you Dad because it's more natural. Let's talk about some of the key transactions or the standout transactions for the first quarter this year. What would be your key standout?
We had a strong quarter, last quarter, but the key transaction for me was 2375 Gold Coast Highway, the Mermaid Village Shopping Centre.
Yeah.
And that we sold for 26 million. We had it's over land size, land content there was just over 4,000 square meters. The net income after land tax turned out to be $700,000 per annum.
Yeah.
And we sold that on an expressions of interest campaign, which fielded over 200 inquiries. We had 14 offers on the property and 4 really strong underbidders. Sold to a local developer stroke investor, and that just showed us for that kind of asset what the depth of the market was.
Yeah.
For that, because all the buyers were local buyers. There were, funnily enough, there were very few international or interstate inquiries. They were all local buyers and strong, very, very deep depth of the buyer market there.
I mean, what that sale price for the listener represented is from an investment perspective, it was a 2.7% net return. So really, the buyer was looking at the land content, which sold for $6,500 a square meter.
Yeah.
And the key part of that sale, I think, Dad, was that it's the largest and possibly the only neighbourhood centre zoning on the eastern side of the highway, which has got development opportunity. And then obviously, we've spoken about this with Dave Ransom. There's a future development uplift with the new town plan whenever that does come into act and that gets confirmed. So. That was a fantastic one for me. And we've done a flurry of investment sales as well.
Yeah, I think you can talk possibly about your retail sales in Southport Central. I think the most recent sale that you did in Southport Central was your 28th or 29th transaction in Southport Central, which I think you can truly be called the king of Southport Central because I don't think anybody else has sold more than you there.
Yeah, well, the whole retail precinct we were fortunate enough to be appointed for over the last 10 years now that we've been working with that vendor. So she originally bought the whole Southport Central retail in one title from the receivers back in 2009. And she slowly but surely, they've always been strata titled since she purchased it, but she slowly but surely offloaded them. So she was very astute not to flood the market, and it's taken us 10 years, but 2 to 3 sales a year. We've contributed towards that almost 30 sales. And the most recent sale was actually a retail tenanted investment, had a very short-term lease, only 12 months to run. We sold that for 6.7% net. What's interesting with that strata sale is we've got another strata sale in Broadbeach, level 1 commercial office that we sold. That sold for a 7.6% return. So the strata sales, certainly we can see the yields softening a little bit when we compare them to some of the freehold sales that we've done.
Yeah, interesting. All those investment sales you had that you've transacted on have had really good inquiry. The offices as well in Broadbeach. So the inquiry's still been strong.
It's that sub $1.5 million price point. Yeah. And then the freehold transactions, I think, is a little bit skewed because we've done freehold on Scarborough Street, which sold for 5% net. We've done a freehold in Mollendina, which sold for around 5% net as well. But what the key thing to look at with these, especially industrial sales, is the market is being underpinned by owner-occupiers. So what we found is that the sales, although tenanted, are actually being purchased by owner-occupiers that have a need for it in the future. Because the market's so tight.
Yeah, exactly right. I think that, again, in terms of the inquiry level, I always judge the market by the inquiry level and the quality of the inquiry. And although maybe it's come off a little bit the last 3 or 4 weeks, and that may be due to Easter and maybe due to the
Election being called.
election being called and a few other reasons. But the inquiry level overall has still been very, very strong.
Yeah.
Dampened a little bit, but still strong.
Yeah, and I think let's put a caveat towards those high interest rates in the strata sales because, I mean, for that price point, investors are really looking for a commercial investment as an income stream. And so for them to make it stack up as a commercial investment and for income stream, it's the return is directly correlated to both the cash rate and the interest rates which people are borrowing at. So I think what we'll see in the next couple of months, and we'll probably touch on this just towards the end of the podcast, is that it's well predicted that interest rates next month will drop by either 0.25 or 0.5% and have a further drop of up to 1% by the end of the year. And so that'll have a direct correlation on yields in the next 12 to 18 months. And so, I mean, I guess what that suggests is that there's really good buying opportunity now because you can still purchase in that high-ish interest rate environment and yield environment. But that certainly will tighten as interest rates come down, as they always do.
Yeah. Well, I think the difference between us and the residential market in terms of when you purchase is that commercial investments are generally and always a longer term investment. It's a long game, not a short game. So the gains on residential property might be shorter, quicker. There may be more uplift, but for commercial investments, I think we have to remember that it's a long-term game for us, and for the buyers.
Average hold time in commercial real estate is 13 years.
Yeah.
Certainly a lot longer, probably double. I don't know the residential hold rate, but probably double or triple what the residential hold rate is because people outgrow homes and they typically buy into bigger and trade up in the residential property, whereas commercial real estate's about paying your debt down.
Yeah, absolutely. Yeah.
So I think it's prudent maybe to break up the commercial market into the different sectors.
Well, give us some commentary on all three sectors. Just a brief commentary on how you see the three sectors.
Yeah, well, they're all performing well, and they're all performing well due to different reasons. Because if we have a look at the office market on the Gold Coast, unlike all other capital markets across Australia, which are seeing vacancy rates of 8% and higher, even 15 to 20% in some of the capital cities, the Gold Coast has actually got a vacancy rate of only 2%. That is attributed because of two reasons. Number one, we haven't delivered any office space other than a couple of developments. I mean, if you take out the office development on Markerry Street that was delivered by Morris Group, I think that you'll find that there's been very little to none office space that's been delivered on the Gold Coast, and so we've had a shortage of supply.
Yeah.
The other big one was that, and we always reflect back to what the impacts of COVID had, but the Gold Coast really didn't adopt a work from home environment. So everybody did go back to the offices, and we've seen that stocks really dried up in precincts which were never seen as CBD precincts. So, people want to work in Miami, Broadbeach and further south because they want the lifestyle, and it's relatively easy to get from A to B still on the Gold Coast, whereas previously Southport was seen as the CBD and the place to have a business. We no longer have that. We've got a really spread office market across the Gold Coast. So with vacancy rates at 2%, does a couple of things as well. It means that as an owner, you've got security because your tenant, number one, doesn't have anywhere to move to. And number two, if they did move, your vacancy rates are low, that your let-up time would be significantly less. With that comes a difference in or a dramatic reduction in incentives that you have to give. So whereas office was once seen as a volatile investment on the Gold Coast, it's actually probably one of the strongest. And then
I've seen that as well. There are no new developments. I mean, I can't think of, while you're talking, I'm thinking, have there been any new office developments?
No.
There's been a few refurbishments,
Yeah.
But no absolutely new developments happening.
Yeah, interestingly, that you're right, the refurbishments come from a shortage of stock, and so people are upgrading C and D grade buildings, and it's the value add opportunity that they present to deliver A and B grade stock because it's more lettable. So that covers the office market. Then if we move to retail's got a current vacancy on the Gold Coast of 6 to 8%. Retail, again, is another asset class where stock really hasn't been delivered.
No, I mean we saw that with the mermaid sale that we did. I mean, over 200 inquiries. The phone did not stop ringing,
Yeah.
and there wasn't that was a bigger centre, but we've been prospecting for smaller centres to see if we can source new properties. But I mean, very very tightly held.
Tightly held, and from the tenant's perspective, that with a 6 to 8% vacancy rate, that is substantially lower than it has been in the past 10, 15 years on the Gold Coast, where the light rail had a massive impact the first stage, and the most recent stage has not had as much of an impact to vacancies as it did in the past, which is a positive thing, and it's because people don't have anywhere to relocate their businesses to.
Yeah.
And then the final sector, and it's well spoken about the industrial sector. I think the industrial sector has got two speeds. I think that there's been a lot of product that's been delivered on the Gold Coast. A lot of that product, if not all, has been under 200 square metres. And so vacancy rates under 200 square metres are relatively high in comparison to over 200 square metres, but that's just because there hasn't been stock delivered over 200 square metres. It's been more financially viable to deliver projects with smaller footprints for the units, and they've really targeted owner-occupiers, man cave style buyers and storage operators, and there's been a massive market missed because people require larger footprints or larger buildings.
So when you say larger footprints, what if you were an industrial developer now? What size would you build a new hub for?
I'd be looking at delivering a floor area of 400 to 800 square metres. I mean, obviously land is scarce, and so it's very hard to deliver that. And you might have to go to outer suburbs, but that's where the amalgamation space and industrial starts to make sense now, because we don't have land. And just like the residential market, where you have to amalgamate to build more density, in industrial properties, you have to amalgamate to deliver more floor area. So that's the one side, and I think though it's really underpinned by owner-occupiers. And so with the tight yields that you're seeing throughout industrial sales, those, and we mentioned earlier on in the podcast, the tight yields are a correlation to the strength of the owner-occupier buyers. They are pinning the price, and that's how obviously properties get valued and how properties get priced, because it's a comparable nature. And a lot of those sales are owner-occupiers, which will pay what they need to pay to get a limited stock.
Absolutely. I think we might end off and just touch a little bit on development sites, because we've sold a lot of development sites in the last 3 years.
Yeah.
And again, it's all position.
Yeah.
I mean, beachside, anything with the view corridor. All right. Again, we are getting strong buyer inquiry, despite the building cost being so high.
Yeah. Well, I think that people are buying to hold, and they're not necessarily acquiring sites to develop in this market. I think when you see an A grade or a blue chip site come available, it's a matter of getting purchasing it for the sake of developing it when it does stack up. But that's unfortunately we see B and C grade sites sit on the market for longer periods of time and don't get those sort of inquiry rates because you're spoiled for choice.
Yeah.
But blue chip sites, you're not spoiled for choice. It's very limited, and when they do come available, we've got a fantastic one at Chugan coming up. If this is broadcasted before it launches, an absolute beachfront site which is going to be very well received, because it's obviously got height in an area which you generally don't get height because of the airport.
Yep.
Well, I think that's enough from us, Dad, today. I mean, that was a synopsis of what the current market is, some of the cap rates being achieved throughout different asset classes. We've touched on vacancy rates and the different vacancy rates between different market sectors. And, I mean, overall, it's good to have you back.
Yeah, looking forward to the last quarter of the year, financial year. I think we're primed for a very good one. And, looking forward to getting stuck in.
Yeah, well, if interest rates come down, it will stimulate a lot of activity in the market. So, I mean, if you are, in this market thinking of buying or selling, obviously please give us a call, because it's a market where if you're buying and selling in the same market, you can't lose. So if you do have a good asset, please speak to us. We can show you how to reposition it. We can, find you alternative properties to buy into and trade up. So there's plenty of opportunities, and we're happy to talk.
Very positive outlook. Thanks, Adam. Thanks for
All right.